Hi everyone. I got a few requests to analyze small finance bank stocks. I got some time back the request to analyze ESAF small finance bank, and more recently I got a request to analyze Utkarsh small finance bank. Now, before we actually get into the analysis, we should all know that banking as a business is very different from any other business in the market. You cannot really have a cost of goods sold or a P multiple as a deciding factor for the bank by its inherent nature is a highly leveraged business. For every 1 rupee of capital it can leverage up to 12 times. Leverage for a bank is essentially the deposits it raises from the public and the NCDs it issues. By its inherent nature, it's in the business of taking money from you, the general public, at a lower interest rate, and then lending the same to businesses at a much higher interest rate and earning the margin in between. So that differential is called net interest margin. Analyzing a bank will be different from analyzing a normal business in a lot of respects. So before we get into the analysis as such, you should know a few terms which are normally used in relation to banking business. The first one of them is return on assets, ROA. It essentially is the PAT number divided by total assets of the bank. Now, what are the total assets of the bank? Total assets of the bank are considered to be the sum total of all the loans given by the bank plus the fixed assets which the bank has on its books. The second term which you should know is ROE, return on equity. Essentially, it's the PAT number of the bank divided by the equity portion. Now, how is ROA and ROE different? ROA and ROE differ in the sense the total assets of the bank are made using two components. One is its own equity, second is leverage, which is the deposits it takes from the customers and the NCDs it raises from the market. So the difference between ROE and ROA is 99% is the leverage which the bank has. Another important concept which you should know is the net interest margin. It essentially is the differential between the amount rate of interest at which it borrows and the rate of interest at which it lends. For example, the rate of interest at which a bank will borrow is 3.5% in case of savings account, 4% in case of savings account, 7 to 8% in case of fixed deposits, and in case it has decided to raise NCDs, it will be about 9 to 10%. However, the lending rates are 9% for a housing loan, 10 to 11% for a working capital limit, even going up to 17-18% for a personal loan, 15%, 13% for a used car loan, and so on and so forth. The differential between this margin, these two margins, these two rate of interests is the net interest margin. Another ratio which you should know is GNPA percentage, which is the gross NPA percentage. Gross NPA is nothing but the sum total of the loans which are overdue. It includes loans which are overdue even 1 day and loans which are overdue for more than 90 days also. Net NPA is only the loan portion which is not provisioned for and which is more than 90-day overdue. So it is essentially gross NPA is that portion of the loan which is in default of some kind or the other. So with these terminologies clear, I personally have a simple way of looking at banks and their performances. We will quickly get into it now. And since this video is dedicated to all the small finance banks listed in the country, we will focus on those specific institutions, right? So in today there are about 8 small finance banks listed in the company. The largest being AU Small Finance Bank and the smallest being Capital Small Finance Bank. What we did was we took the Q1 25 performance data. We picked up their presentations and we pulled out a few numbers out of it. You can see the screen here. We pulled out numbers like the price to book value, the PE ratio, the ROE, return on equity, the return on assets. Then we calculated something called ROE upon ROA to understand the kind of leverage it has. We also pulled out net interest margins and GNPA percentages. And then we pulled out the number of branches and the gross loan book of the bank. And from these two numbers, we calculated the average loan book per branch. Now, if you look at the data on its own, it ranges, we'll take the ROE data first. The ROE data ranges from a low of 1.7% for Equitas Small Finance Bank to a very, very high of 18.8% for Jana Small Finance Bank. The ROA similarly ranges from a 0.22% for Equitas to the highest of 2.9% for Ujjivan. The net interest margins which the banks enjoy ranges from a low of 6% for AU Small Finance Bank to a high of 10% for Suryoday. This essentially indicates that AU Small Finance Bank will have more of its portfolio in secured space. Secured loans are normally car loans, home loans, and so on and so forth, and those are normally available at cheaper rate of interest. Whereas the others like Utkarsh Small Finance Bank, ESAF Small Finance Bank, Suryoday Small Finance Bank will have their loan portfolio mostly in the unsecured or space where you can charge a premium. We could charge a premium rate of interest, and the customers will still accept it. It is generally unsecured in nature, so that is what the indication is. Similarly, if we look at the gross NPA percentages, the best is AU Small Finance Bank at 1.78% gross NPA. That means the book is doing very, very well. The defaults are very much under control, and the credit underwriting which it has done is also of a very, very good quality. The highest NPA ratio was of ESAF Small Finance Bank at 6.6%, which is a pretty large number. If not controlled on an immediate basis, it may spiral downwards into something much more messier. Now, these numbers on its own really don't tell me anything. So what we did was we went ahead and we went ahead one step. We ranked these banks, since there are 8 banks, so we ranked these banks in a certain order for few of the parameters, key critical components which we have. We rank them on a scale of 1 to 8, 1 being the best, 8 being the worst. And we will quickly get into the rankings and see what the results are. So first and foremost ranking which we did was ROE upon ROA, which gives me the leverage position of the bank. And it also tells me that if the leverage is lower, then the bank has the ability to lend more and more without really diluting any capital. So we ranked all the banks from 1 to 8, 1 being the best, 8 being the worst. And similarly, we rank them on net interest margin. Of course, we want our businesses to have higher margins. So higher the net interest margin, lower the rank. This tells me the product makes profitability at the base level. Higher margins essentially help me in absorbing higher shocks and higher costs at a future date. In case the defaults go up by 2%, I can absorb it better when my margin is 10% rather than when my margin is 6 or 5%. So higher the margin, better it is. Then we looked at gross NPA percentages. In this case, lower the gross NPA, the better it is. This essentially tells me how strict the bank is in terms of giving out loans, what is the credit quality of the portfolio of the bank, and how good is it at collection efficiencies. The lower, the better. Then we calculated loan per branch. Essentially, this tells me the distribution efficiencies. For every branch, I would like to have a much higher portfolio than a smaller portfolio. That is where the returns of economies of scale kick in. Again, the higher the portfolio per branch, the better it is. And lastly, we looked at the valuation. For banks, instead of a PE valuation, I prefer looking at a price to book value valuation. And in this case, the lower the price to book value, the better it is. So a bank with a lower price to book value will be rated the best, and the bank with the worst price to book value will be rated the worst. So in the end, we have 5 different parameters on which we rank the banks: price to book value, ROE, ROA, NIM, GNPA, and loan per branch. And then what we did was we averaged out the ranking. We did a simple average without giving any additional weight to one particular parameter. The resultant final rankings gave me a very, very clear indication in terms of the entire bank's performance, whether the bank is efficient in distribution, whether the product mix is profitable, whether the collection efficiencies and the credit control is good, whether the bank can continue disbursing loans without running into capital adequacy issues, and whether the bank is available at a fair value or not. So if I calculate all these five parameters, I got a certain ranking. If you look at it, the average ranking of all the banks, again, this is out of 8, right? So average ranking of all these banks, the smaller the better, because 1 is the best ranking and 8 is the worst ranking. So Ujjivan Small Finance Bank wins hands down. It has performed well in almost all the parameters. It has been in the top 2 and 3 banks in all the parameters as such, with an average of 2.6. I believe Ujjivan Small Finance Bank is at this point a compelling value proposition and should be considered for further investment analysis. The second best was Suryoday Small Finance Bank. It did very well in terms of ROE, ROA, and net interest margins. Now that means the product mix is very, very profitable. It is also did very good in the valuation matrix also. But where it did not so good was GNPA, which is the NPA percentages, and the loan per branch, the distribution efficiencies. It was one of the worst in terms of distribution. But overall, if I look at all the five parameters, yes, the ranking was good. Then AU Small Finance Bank and Equitas were more or less at par. So these two were joint third. So if I look at the ranking as such, between these 8 small finance banks, if we want to invest only in one, then I would consider Ujjivan Small Finance Bank as the bank to further investigate. What are the limitations of this particular model? One, all these numbers, ROE, ROA, net interest margin, change from quarter to quarter. They fluctuate. The rankings today, one bad quarter, the rankings may change dramatically. Secondly, one or two large events, whether natural or calamity, can change the entire NPA percentages and again change the ranking as such. Third, the size of the bank. I'm not considering in this size of the bank, I have ignored the size of the bank. For example, AU Small Finance Bank today has a market cap of 45,000 crores. A Capital Small Finance Bank has a market of 1400 crores. If I talk in the strictest of the senses, this is not even comparable. The market cap of AU Small Finance Bank is actually larger than the next the balance 7 listed small finance banks put together. So, is it comparable? No. With certain size comes certain cushions, certain flexibilities, and certain safety. So, is it comparable? No, it is not. So, that is one more weakness of the study. Third weakness of the study is that this is just a ranking system. Whether there is systemic, what is the management's forecast, how dynamic is the management, what is the kind of growth the bank is looking at, is achieving, what kind of numbers are they targeting. It is not really considering all this at all. It does not take into consideration the management's vision and its ongoing execution and the future direction. And also, the whole model as such is a much simplified model. Absolutely maybe incorrect, of course, the disclaimer being that this is what I use, maybe absolutely wrong. But broadly it covers, it gives me a very good indication in terms of classification, and I would suggest that look at the model as such. So with that, I hope that I have made you think. And going forward, we will do another ranking of, another similar ranking of all the private sector banks. And then we will, of course, in the end, take PSU banks. And once we are done with the 3 videos, maybe we can do a comparison of all three. In the comments, let me know if you would want to see that. With that, I'll see you in the next video. Thank you so much.